Okay folks, well, I gotta admit here, I told a little bit of a fib on the last video that I did talking about sellers contemplating a seller finance offer. I mentioned in there that all three of the things that I'm going to talk about are of equal importance, and it kind of depends on the circumstances, but I really feel that this point here is probably the most important one. So welcome to thecreditjungle.com. This is George Anderson.
George of the jungle, strong as he can be.
In the first one we talked about the insurance, and there's a good video there that explains why you need to change the type of coverage that you have once you have moved out of your house and sold it on seller finance, regardless of what type of terms that contract is. The type of terms of that contract is what we're going to discuss here, and this is a big deal. There's kind of this has been around forever, and it just comes with different acronyms, different names, and I've seen a lot of MLS listings lately in the state of Utah that basically say SUB and the number 2, sub 2. And those who are in the business understand that that means subject to. So it means that the seller has agreed to sell a property, to transfer the title of the property with a warranty deed that just acknowledges that there is an underlying mortgage. So let's just look at an example where we have a sales price of $500,000. The investor is going to put down $100,000 and take over a mortgage payment that's like, it's a nice juicy 3.5% 30-year fixed rate loan at $400,000. And the seller says, well, that's great. I'm okay with the sales price. I'm okay getting $100,000 down. And the investor promised me that he would make the payments on my underlying mortgage. Can you see what the problem could be on here? Yeah, what if this investor or the person who buys the house really doesn't want to do anything with it other than to fix it up and flip it, or to rent it out as long as they can, do whatever they want? Mind you, $100,000 is a substantial investment, but where does their obligation to make the payment on the underlying mortgage? And more importantly, what is your recourse as a seller if he doesn't pay? Well, under a subject to, there really is no recourse at all. So if the buyer ends up missing his payments and you get notice of this, sure, you as the seller can go in there and continue to make that payment, but what says that you're going to get your money back? I mean, you might be preserving your credit, but you have no way to be able to recoup those funds because you don't have any obligation to do that. So the best way to protect against this as a seller, you can accept the numbers here, but what I'm suggesting on the terms is that you put together an all-inclusive trust deed, or what they sometimes call a wraparound mortgage. And that is basically going to put a little security blanket around this $400,000 mortgage, where you're going to have an all-inclusive trust deed, and this is important, that mirrors the terms of the underlying mortgage. The buyer is getting exactly what he wants. He's getting the purchase price, he's getting it with the amount of money that he wants to put down, and he's taking over the remaining terms of that mortgage at its current interest rate with, let's just say there's 26 years left. You can make the terms on the all-inclusive trust deed exactly the same. $400,000, 3.5%, 26 years left. So there's no change at all in the terms there. The difference is what happens is if the buyer becomes delinquent on the all-inclusive trust deed, okay, you as the seller can make sure that those underlying mortgage payments continue to be made, and you can make the payments on those so that the underlying mortgage is current, but the all-inclusive trust deed is not. And if it's in default and you have to start doing a foreclosure, you can do the foreclosure on the all-inclusive trust deed. Okay? What that does, that ensures that anything that you've had to do, your attorney's fees, your late fees, your penalties, anything that's accrued on there that matches that underlying mortgage, you can, at the time of the sale, you can get all of that money back because you are a creditor that basically has a lien position just slightly, just the next in line above the first mortgage on there. And that way it preserves your credit, and you make sure that you're at least going to get the money that you've put out to keep the mortgage current. You're going to be able to keep that. So that's the best advice I can give to a seller on doing the structure of the transaction to make sure that you avoid the subject to a warranty deed, subject to transaction, and just protect yourself. And if the buyer says, well, why are you worried about that? I'm going to make the payments. Well, if you're going to make the payments, then let's just go ahead and just create the contract that obligates you to do so, because under the warranty deed subject to, there's no obligation for him to make the payments. So anyway, thanks for coming into thecreditjungle.com today. This is George Anderson, Push Button Get Mortgage Professional. And these are the types of transactions that I normally find out about these things after the fact. I'm hoping that somebody watches this video and maybe catches it at a little bit better timing, because we want to preserve your capacity as a borrower to be able to get into another house. So take care, and we'll talk to you soon. Bye-bye.
George of the jungle, strong as he can be.